I'm Aarati Krishnan and you're watching A to Z of stock market investing. Today let's look at O for open offer. Imagine you're super bullish on crude oil and therefore went and bought Cain India, a stock listed on the Indian stock market in 2010. Basically, Cain was supposed to become one of India's largest oil producers, pumping out 2.4 lakh barrels of oil per day in a couple of years. Suppose Vedanta PLC, a company engaged in mining, copper, zinc and aluminium, came along 1 year later and just bought a majority stake in Cain India. Would you feel cheated? You probably would, because you bought into Cain thinking that it's an oil company, right? It is to give shareholders who are caught in such situations a fair exit from the company that SEBI has something called the Takeover Code. The Takeover Code has a detailed set of rules and guidelines which are designed to ensure that acquirers of a public company shares also have to make an open offer to the shareholders, the public shareholders of the company, in order to mop up their shares at the same price. This is meant to ensure that promoters do not strike any sweet or private deals with acquirers in order to sell out their shares at an attractive price and then leave public shareholders in the lurch. Basically, as an investor, when you choose to invest in the stock of the company, the basic factors that you look at are management, the business profile, the strategy and business plans of the company. Whereas when an acquirer steps in and takes over the company, all of these things can be subject to change. Therefore, the initial reasons for which you bought the stock may no longer be valid. This is the reason why SEBI requires the acquirer to make an open offer so that all the shareholders who bought the stock based on certain management or business plans get an opportunity to sell when the management changes. Not necessarily. SEBI specifies 3 different triggers for an acquirer to make an open offer in a publicly listed company. One is if the acquirer acquires, say, 25% equity stake in the company from the promoters, then he has to compulsorily make an open offer in order to acquire another 26% from the public shareholders. An open offer can also be made on a voluntary basis. For example, a few years ago, we found that Unilever PLC, the parent company of Hindustan Unilever, wanted to increase its stake in the Indian arm. To do this, it made a voluntary open offer to the public shareholders of Hindustan Unilever. The third circumstance in which an open offer gets triggered is when there is an indirect change in the control or management of a company. Suppose an acquirer uses a lot of holding companies in order to acquire an indirect equity stake in an Indian company, even then SEBI's open offer rules can get triggered. Well, as soon as an agreement is signed for an acquirer to buy a stake from the promoters, the company is supposed to immediately announce this to the stock exchanges. The acquirer is also supposed to take out an ad in the major newspapers announcing that an open offer will be made. Both the beginning and the end dates of the open offer will be specified in this advertisement. The price will also be given. Thereafter, the company actually mails you forms and you can decide whether to participate or not participate in the open offer based on the price that is being offered. Well, some shareholders have really become rich by participating in open offers. For example, in the HUL offer, the stock was trading at 480 to 490 rupees in the market, but Unilever suddenly announced a price of 600 rupees. But SEBI has certain rules which determine how the open offer price is determined. So there are 3 criteria that SEBI lists out, which are presented in the graphic accompanying this. What if I'm a shareholder in a company and I'm quite happy with the change in management? Well, there's no compulsion that you should participate or tender to the open offer. You can continue to hold on to your shares of the company. Unlike the Godfather's offer, this is an offer that you can definitely refuse.